Ever wondered what those colorful bars on a trading chart signify? Those are called candlestick patterns. Originating from Japan over 3 centuries ago, these visual tools have become a vital part of technical analysis in trading. Each candlestick represents a specific time frame and displays the opening, closing, high and low prices during that period. The body of the candle is colored, or filled, if the market closed lower than it opened, and hollow or unfilled if the market closed higher. The real beauty of candlestick patterns lies in their ability to convey complex market information in a simple, easy-to-understand format. They give traders an edge by providing insight into market sentiment, helping to predict potential price movements. So whether you're a seasoned trader or just starting out, understanding candlestick patterns is a must. So candlestick patterns are more than just colorful bars. They hold key insights into the market's movements. Now that you know what a candlestick pattern is, understanding its components is crucial. A candlestick is made up of 4 main components: open, close, high, and low. Let's break this down together. The open is the price at which the period opens, while the close is the price at which it closes. These two form the body of the candlestick. If the close price is higher than the open price, the body is usually filled or colored. But if the close price is lower, the body is typically hollow or a different color. Now onto the high and low. These represent the highest and lowest prices reached during the period and form the wick of the candlestick. The wick can be above, below, or on both sides of the body, indicating price fluctuations. Remember, the body and the wick of the candlestick tell us about the price range and the opening-closing prices for the period. Candlestick patterns are not all the same. There are various types, each telling a different story. Now let's delve into some of the most common types and understand what they signify. First off, we have the doji. This pattern appears when the opening and closing prices are virtually the same. It resembles a cross or plus sign and signifies indecision in the market. It's like a tug of war between buyers and sellers, with neither side gaining a clear advantage. Next up is the hammer. This is a bullish pattern that forms after a decline in price. The candlestick looks like a hammer, hence the name. The small body at the top and a long lower wick tell us that sellers drove prices down, but buyers were able to push them back up, indicating potential reversal of a downtrend. Now let's talk about the bullish engulfing pattern. This is a 2-candle pattern, where a small negative candle is followed by a larger positive one, which completely engulfs the first. This suggests that buyers have taken control, and a bullish reversal may be on the cards. On the flip side, we have the bearish engulfing pattern. It's exactly the opposite of a bullish engulfing pattern. A small positive candle is followed by a larger negative one that engulfs the first, indicating sellers are in control, and a bearish reversal might be imminent. Finally, let's touch upon the morning star and evening star patterns. The morning star is a bullish 3-candle pattern, indicating a potential bottom and reversal of a downtrend. The evening star, on the other hand, is a bearish 3-candle pattern, hinting at a potential top and reversal of an uptrend. Remember, these patterns are not absolutes. They're more like clues, giving you a peek into the market's psyche. Each pattern presents an opportunity to gauge market sentiment, helping you make informed decisions. These patterns, once identified, can provide valuable insights into potential market reversals or continuations. So, keep a keen eye out for these patterns as you navigate the fascinating world of trading. Knowing the types of candlestick patterns is one thing, being able to read them is another. Now that you're familiar with the different candlestick patterns, let's dive into how to read them on a chart. Imagine a chart as a storybook, and each candlestick pattern as a sentence. Just as sentences form paragraphs and stories, candlestick patterns form trends and market narratives. Reading a single candlestick pattern is akin to reading a sentence in isolation. It might make sense on its own, but without context, you're missing the bigger picture. Let's take the bullish engulfing pattern, for example. On its own, it could indicate a potential uptrend, but consider this pattern in the context of a downtrend. It takes on a whole new meaning, doesn't it? It could signal a possible trend reversal, a key insight for traders. In the same vein, a doji pattern might not say much on its own, but pair it with a strong uptrend and you might have a doji top, a potential indication of an upcoming downtrend. Remember, the market is a complex beast. It's constantly changing and evolving. Candlestick patterns are not magic bullets, but tools to help navigate this beast. They should be read in conjunction with other patterns, market trends, and indicators. Understanding the context is crucial in making sense of the patterns. It's akin to being fluent in the language of the market, and that's what we're aiming for, isn't it? reading candlestick patterns correctly can help traders make informed decisions about their trades. It's about making sense of the market's ebbs and flows and using that knowledge to your advantage. Mastering candlestick patterns requires practice and patience. Just as a seasoned chess player can predict moves on the board, a skilled trader can anticipate market trends by interpreting candlestick patterns. You see, understanding these patterns is not just about memorizing their shapes and names. It's about comprehending the psychology of the market, the emotional tug-of-war between buyers and sellers. The more you expose yourself to these patterns, the more you'll start to see the stories they tell. Let's talk resources. There are countless books, websites, and forums out there to help you sharpen your skills. Websites like Investopedia offer comprehensive guides and quizzes on candlestick patterns. Books like Japanese Candlestick Charting Techniques by Steve Nissan provide in-depth insights into the origins and applications of these patterns. Interactive charting platforms are another great tool. They allow you to apply your knowledge in a risk-free environment, so you can get a feel for how these patterns play out in real time. You can also join trading communities online to learn from experienced traders and share your own insights. Remember, mastering candlestick patterns is not an overnight process. It takes time, practice, and a willingness to learn from your mistakes. But once you've grasped the subtle art of reading these patterns, you'll be able to make more informed trading decisions. Remember, mastering candlestick patterns can give you an edge in the trading world. So, keep practicing